Growth investing is a strategy where investors focus on buying stocks of companies that are expected to grow faster than the overall market. These companies might not pay dividends now, but they reinvest their earnings to expand their business, which can lead to big returns for investors in the future. Let's break it down with simple terms and an easy example. Growth investing is about identifying companies with strong potential. These are often companies in industries like technology, healthcare, or renewable energy, where innovation drives rapid growth. Think of companies like Tesla or Amazon in their early days. They weren't profitable right away, but their growth potential attracted investors who believed in their long-term success. Here's a simple example. Imagine you invest $1,000 in a company called Green Tech, which makes innovative solar panels. Green Tech isn't paying dividends because it's using all its profits to develop better technology and expand its market. Over the next 5 years, as demand for clean energy increases, Green Tech's revenue grows rapidly, and its stock price doubles. Your $1,000 investment is now worth $2,000. That's the essence of growth investing, betting on future success. But growth investing isn't without risks. Because these companies are focused on reinvesting their earnings, they often carry higher valuations, meaning their stock prices are already expensive compared to their current earnings. This makes them sensitive to market changes or disappointing results. For example, if Green Tech's new solar panel doesn't perform as expected, its stock price could drop quickly, and investors might lose money. So, how do growth investors pick stocks? They look for companies with high revenue growth, strong leadership, competitive advantages, and large market potential. For example, a company that's dominating an emerging industry with innovative products and a growing customer base might be a great growth investment. Growth investing also requires patience. Unlike dividend stocks, which provide steady income, growth stocks often don't pay dividends because they're focused on reinvestment. The payoff comes from the increase in the stock's value over time. This makes growth investing ideal for long-term investors who can handle short-term ups and downs. What's the difference between growth and value investing? While growth investors focus on companies with high future potential, value investors look for stocks that are undervalued by the market and trading at a discount. Growth stocks tend to be riskier but offer higher potential rewards, while value stocks are often more stable but with slower growth. In summary, growth investing is a strategy where investors buy stocks of companies with high growth potential. These companies reinvest their earnings to expand, offering the chance for significant long-term gains. While it involves risks, growth investing can be highly rewarding for those who are willing to research carefully and stay patient.